Okay, so we're going to go ahead and get started with chapter 3, which is completing the application, underwriting, and delivering the policy. So the first term we're going to go over is illustration. So illustration is something like a picture. So you have a picture of what your policy could look like, right? But if everyone is getting a picture of what their policy could look like, that means that most likely it's not what your policy is actually going to be. So what you have is something called non-guaranteed elements. It's things that aren't guaranteed. They look nice, but doesn't mean you're actually going to get them. The next one is the buyer's guide. Buyer's guide has generic information. It's kind of like a pamphlet about life insurance, right? So if you want to look up term life, you look in the buyer's guide and you have very generic information about term life, just enough where you're like, okay, I know what it is, but not too much where you're like, I'm overwhelmed, right? And I was thinking like if you were going to go travel to a foreign place, right? When you get a brochure, it tells you like, these are good things to bring, and this is what you should have beforehand, or places to visit, things like that. It's enough information where you're like, okay, I think I know a little more, but not too much, right? The next one is the field underwriter. Field underwriter is us, the agents, whether unlicensed or licensed. A field underwriter is the agent, because when the company gets an application for a client, most likely the company is just looking at a name, right? They're just looking at the name of the client, but they are not looking at the actual client's face. So we can put a face to the name, right? We are the ones that physically look at the client, and we're the ones that are in the field. Premium receipts. So there are 2 premium receipts. I'm going to go over the second one first. And the second one is a binding receipt. So when you see a binding receipt, most of the time you will see it when it comes to property insurance, so like house and cars. Because with the binding receipt, the moment you get a binding receipt, you're covered, right? So let's say right now, I got car insurance, and then I drove away 2 seconds later and I got in a car accident. I'm covered because a binding receipt covers you immediately. Now with life insurance, right, people aren't covered like right away. They have to go through the process of getting approved, right? So what we give them is something called a conditional receipt. They are conditionally covered. So if they pass away before the company approves or not approves them, basically the company will pay out if they are going to cover the person. And if they weren't going to cover the person, they're not going to pay out. When I took my test, the way I looked at it was, I thought of binding like marriage, right? You're married to the company is going to follow through, they're there, right? Conditional is more like you're engaged, right? If you're engaged and something happens, you're not married yet, so there's no divorce papers, there's nothing. You just break up, right? Take the ring off, keep the ring, and then you're like, it's done, right? So same thing, the company is engaged to you, and basically if they wanted to, they could take the ring off and not pay out, or they could follow through and pay out the death claim. So conditional is like engagement, and binding is kind of like marriage. Okay, non-medical. Easiest note that you guys can write, that I would write down on your paper, because it's better if you write things down because you remember it better. So non-medical is medical questions, yes. Medical exam, no. So there are some policies that actually don't require a medical examination. They don't need you to do the medical exam, but all policies, no matter what, you do have to fill out the medical questions. That is the underwriting. That is how the company chooses who they're going to approve or not, with the medical questions. So medical questions, yes. Medical exam, no. Where you see these types of policies usually are with small amount of coverage. So if someone's getting a very low amount of coverage, most likely the company will not say you have to take a medical exam, but they will say you still have to fill out the questionnaire. You just have to submit that, and you don't have to do anything else outside of that. Now, lab testing and HIV. So if someone was to get tested, then before they even get tested, before they got poked with a needle or anything, the nurse that's going to do the exam on them, they're actually going to say, sign here, initial here. Why are they doing that? It's so that if the person if the person, you know, happens to faint or something happens to them, there's written consent from that person that they said it was okay for us to test them, right? Like if I'm getting tested, my mom can't say, yeah, you can go ahead and test her. Like, no, the consent has to come from the person getting tested, okay? 3, premium determinations. So three things that come in to play when companies are giving quotes for clients, right? If you guys have ever noticed that some companies, they actually are more expensive than other companies, but it's the same coverage, right? Same coverage, same amount, it's the same policy, but why did some companies charge more and some companies charge less? Now, this is where that comes into play. This is how it works. So mortality is the first thing, and mortality is used by everyone. It's the same. It's your rate of death, right? They use a mortality table, basically like a little timeline. They say, here's where you were born, and then here's where we think you're going to pass away. And then based on your age, they kind of just put a little pin and with your name in it, and they say, you're here. Right? And people that are younger usually pay less, and people that are older pay more because they say that they're closer to that end, right? Statistically speaking. So the mortality table is just, they put you on a mortality table and they pin you and they say, you're here. So if you're farther away, you pay less. If you're closer, you pay more. The next two, they kind of go with or against each other, and most of the time, this is where the price drastically changes by company. So interest and expense. So interest, let's say interest is high. Interest represents the money that the company has made, okay? And expense is obviously the money that they're spending. So if interest is high, expense is low, that means the company is making a lot and they're spending not that much either. So that means they've made money. So if they've made money, most likely they don't need to charge their clients much. But let's say it was opposite, expense is high, you know, and interest is low, means they're spending more than they're making. Now, if you're spending more than you're making, most companies say, well, we need to make more money. And how do you think they're going to make more money? They're going to charge their clients more. Okay, so if you look down here, there's asterisks. It says if expense is higher than interest, then the client is going to pay more. But if interest is higher than expense, then the client pays less, right? So that's why with Primerica, we give quotes and they're usually lower because we don't do, you know, TV advertisement. We don't own a stadium. And those are things that cost a lot of money, right? Other companies, they do commercials. They have, you know, football stadium, a soccer stadium, things like that. So it costs them a good amount of money. So because they have all those extra expenses, they're going to charge their clients more so that they can continue to do that. Okay, next page, premium mode, frequency, premium mode. Frequency. How often are you paying for your policy? Are you paying every year, right? Annual, semi-annual, quarterly, monthly, right? That's, you get to choose that. You get to choose how often you're going to pay for your policy. Now, if you see right here, it says annual is cheaper in the long run. What does that mean? As the whole life of the policy, annual is actually going to charge you the least amount of the four. Now, why is that? Is if you look at the last bullet point, it says if premium is paid more frequently, then the additional charge will be added because of expense involved in billing. So basically, it's like a billing charge, right? If I have to bill you, you know, twice a year or every month, right? The company is going to charge a little fee because they're saying we have to send you a bill. It's going to be consistent. But the person that pays annually, they're not going to be charged that billing fee. So they're going to only be charged that one time regular fee. Replacement. Replacement is only replacement if you change the company. Okay, so it's kind of like if I sit down with a client and let's say they're with State Farm, right? And I come in and I give them Primerica, I've changed the company, therefore it's replacement, right? But let's say I sit down with someone and they already have Primerica, then we're gonna go ahead and say that it's not replacement because I'm just changing their policy. I'm not really replacing their policy, okay? Now, there is a replacing insurer, if you guys remember, insurer with an ER, okay, is the company. And then there's the existing insurer, right? Existing insurer is the person getting replaced. Now, if you are my client and you call me up and you say, hi, I'm switching over to another company, do you think I'm just going to be like, okay, bye, like, see you later? Like, no, I'm not going to let you just leave. I'm going to make sure that I find out why, try to maybe tell you not to switch, right? So what do? I say, let's have some coffee, let's do this. What am I trying to do? I'm trying to save the policy. So conservation is the policy that's getting replaced, that company. We're trying to dissuade you from replacing, so if you don't switch over to the other company, you stay with us. Exclusions, this is things not considered replacement, is credit life, group life, anything that says same company. If it says same company, automatically you know that that's not replacement. The next two, life settlement. So life settlement is something that it goes more in detail in chapter 5. Okay, so life settlement is you're giving ownership of your policy to someone outside of yourself or anyone that's in your policy. So let's say you're going to give ownership to a bank or things like that, or to like someone that isn't in your policy. What you're doing is you're doing an absolute assignment. Absolute assignment is you're assigning someone else to be the policy owner of your policy. Right to rescind. So we kind of went over this in chapter 2. So right to rescind is when someone has kept something from another party and it caused the other party to feel cheated, lied to, and it causes the company to say the policy is void. It's no longer, it's not valid, right? Now, obviously, let's say someone lies to you. If you tell me, oh, this person lied to me, and I'll say, oh, what did they say? And I'll say, when did they say it? And you tell me, oh, they lied to me, 2 years ago, right? Is that a valid, like, you're not going to really remember what they say. But if you say, oh, they lied to me yesterday, that's a little more recent. That means that makes it a little more valid. So 30 days from the time that we sit down with the client, we need to make it known or find out anything that they kept, or 15 days from the policy being issued, right? So either 30 days from the first sit down or 15 days from the policy being issued. That's when we need to find out any of these things. So if we can make it known and make the policy invalid, but after that time has passed, then you can't say, oh, this was left out or this wasn't said, because now it's not valid because a lot of time has passed. Okay. Going into the next page, so you'll see 3 columns. I'm only going to go over the highlight because and the next page I'm going to go over is kind of a diagram of kind of what this is saying, right, in a picture, because I am a visual learner. So if you aren't, you go ahead and read the page, but if you are, then the picture will work much better for you. So the MIB, right, the Men in Black, is the Medical Information Bureau. This is something that's made by insurance companies, funded by insurance companies, and used by insurance companies. It's a medical database so that we can look up a client if someone applied in another company and then they come to apply with us. What we can do is we can look up in the MIB their information, so that if I have to start looking at your medical records and all that stuff, I don't have to start from scratch. I can kind of piggyback off what the other company started, right? So if they said, oh, we found this in their medical record, we can kind of look that up and then continue on. The next one, it says, if no premium was collected with the application, the agent must collect premium and a signed statement of good health. So what does this mean? So if when I first sit down with you, I don't collect any money, no premium, right? Because premiums are payment, I don't collect anything. But I find out you got approved and I come back with your policy. I say, hey, you got approved, right? When I come back with your policy, that's when you're gonna start paying for your policy. So you give me the premium, but also what I'm gonna do is I'm actually going to get a signed statement of good health. Basically what it means is you're telling me that from the first time I sat down with you till now, your situation and condition has not changed, right? So signed statement of good health is just saying, I'm still the same. Nothing has changed, okay? Now, in the books, you will see things like see page 18 or see page this. You're going to look at the bottom right-hand corner. There are page numbers. Those are the numbers you want to look at, and you go to the page that it's telling you. So it says see page 18, so we're going to go ahead and scroll. So here's the diagram that I was talking about. This is the process in which someone goes through to become a client. So first of all, you're an applicant, right? You're applying for life insurance, and your application will be sent over to the company, also known as the insurer, okay? Now, the insurance company can do two things. Either they deny you because you're too high of a risk. They say, you're too risky, we can't cover you. Or they're going to put you into a classification, right? And the classification is based on health, things like that, right? So preferred is someone great health, great weight, great everything, right? That person is actually going to pay less than everyone else. Standard is just a normal average person. They're not healthy, they're not unhealthy, they're just kind of in the middle, normal, right? So this person would pay the normal rate of premium. Now, substandard or rated is another way to say it. This is person that's higher risk, but they're not too high of a risk that the company says, no, we can't cover you. They do cover them, but they are going to charge them more. Like if someone, you know, has diabetes, but it's controlled diabetes. So the company covers them, but they still have something on their record. So therefore, they're going to go ahead and have to charge them more. Now, health is not the only reason why a company would tell someone like, sorry, you can't be our client. There's someone that actually got denied because they were getting in too many car accidents, right? So if it's too many of the same type of risky things, then most likely some companies will say you're too high of a risk, and they'll deny you, or they'll put you in another category. Like if you're constantly skydiving or something like that. Those are things that companies put into factors that they put in. Now, once you get put into a classification, you'll get something called an issue date, a day they issue you a policy. And once they issue you a policy, you are now considered an insured with an ED, right? Insured, ed is a person. That means you are now a client with the company. Now, let's say I'm your agent, right? I have your policy. Now, who should have your policy? You, right? So I need to set up a delivery date, a day I go and deliver you your policy. Now, with delivery date, you have something called the free look period. The free look period is the time to look through your policy and decide, is this really what I want, right? So if you decided, you know, you look through the policy and you're like, no, actually, this isn't what I want, then you would go ahead and get a full refund of any money you put in, and the policy, you know, doesn't happen. But if you look through your policy and decide, yes, this is what I want, then your policy just continues as normal. Now, the free look period is different based by person. So if you're under the age of 60, you'll get 10 days. If you're 60 and over, you'll get 30 days. And if it's replacement, it doesn't matter the age of the person, they're going to get 30 days. Because if you think about it, if they're replacing their policy, it means they have a new policy with us, an old policy with the older company. So that means they have two policies to look at, because they need to decide, is replacing really the option that they want to go with, right? So it doesn't matter the age. So make sure you guys are reading your questions, because if it says replacement, I don't care if Bob is 35. If it's replacement, he'll get 30 days, no matter his age. Okay, grace period. Grace period is when you miss a payment, right? So let's say you miss a payment by accident. It happens, right? So you miss a payment, you'll get 30 to 31 days to pay back that payment. Now, you see I said 30 to 31. So 30 or 31. So if you see 31, that's the more right answer. That's the one you really want to go with. But let's say 31 isn't an option, then go with 30, okay? So you get that time to pay back your policy, okay? Now, let's say you pass away in that time period before you paid back your policy. What you can do in that time, if you didn't pay it back, the company will still pay out the policy, but what they'll do is they'll actually take out what you owed them. Then they're going to go ahead and pay the rest of the death benefit out. Now, if you don't, let's say you don't pay back your policy in those 30 to 31 days, right? After that time has passed, your policy actually does lapse, and lapse means cancel, okay? Lapse means cancel. So if you have that time frame, they say you have this many days to pay back the policy, or else, you know, the policy is no more. It's kind of like when you pay your bills, right? If you stop paying a bill, right? Let's say you stop paying your gas bill. If you don't pay it, they say pay, you know, pay now, pay now, pay now, and you stop paying it, most likely what's going to happen? They're going to turn off your gas. Same thing. If you stop paying for your policy and we're saying to pay it back and you don't pay for it, most likely, eventually your policy turn off, right? You won't have it anymore. Now, if you go down here to the timeline, the dates don't really matter, like the month and the year, things like that. It's more putting it all into a time frame. So let's say May 1st, 2016, this is the day you applied for life insurance. Let's say May 10th, 2016, there's an issue date. It means you got issued a policy. Let's say on the 30th of the same month, I delivered your policy. And remember, if you get a delivery date, that means you go into free look period. Let's say on December 1st, 2017, you missed a payment. You go into grace period, I call you up, we fix everything, it's fine, right? Now, May 10th, 2018, how many years after the issue date? 2. After 2 years of having your policy, you get something called incontestability. Incontestability basically is like the company cannot fight the claim. In the first 2 years of your policy, if you pass away or something happens, the company can, doesn't mean they will, but they can fight the claim or find a way not to pay out the death benefit. But after 2 years, the company has to pay out the death benefit. So an example is suicide. If someone commits suicide in the first 2 years of the policy, the company's not going to pay out. All they're going to do is say, hey, this is how much money that person had put into their policy. We're going to give that back to you guys, but we're not paying the death benefit. But if someone commits suicide after 2 years of having the policy, then the company will pay out the full death benefit. Okay?